Hey, did you know that it's possible to lose more than the max loss on an option spread? Well, it is, and some folks who didn't woke up to a real surprise this morning, a painful surprise that I want to help you avoid. So, some folks were in a trade similar to one we did in the Voodoo Mastery Room, where we saw some elevated premium in app lovin on Friday. And so we wanted to sell some options to capture that premium. And we did it with a strategy that had a limited max loss. So at the time, we were trading at about 485 or so in app lovin, and as I mentioned, the call premium was really elevated. So we said, you know what? If those calls are anticipating a move up, maybe we play for a 2% or 2% plus move up to 495 into the close or so, and not have any risk if we don't bounce. No risk down here near 485 and lower, but risk above 500 by coming in here and again selling the inflated premium, selling 3 calls at 495, buying a 485 call, right, and buying 2 500 calls to create our unbalanced butterfly. We collected a buck 30 in premium. So that means if app lovin had hung out down here, we make 130. We could have made up to 630 if things expired right at that 495 center strike. But the max loss, which your platform will show you, right, and the toss analyze tab will show you here above that 500 strike is $370. Now, there's a formula for any option spread, and the one with these 1, 3, 2 unbalanced butterflies where the wings are equal width, right? So they're equal width on this one. Each 5 points above and below the center strike is the width of the wing, 5 points, less the credit received, which for us was a buck 30. So our maximum is a 370 max loss, or $370 per butterfly. So knowing that, and knowing that my risk was contained, I did 10 of these, which for my account is fine. It's a very small percentage loss, and something that if I do something like this 100 times and profit most of the time, I can handle the few times that it's a loss. And that's the sort of thing that I wanted to do. Now, here, let me walk you through where and when the problem comes in, because while it's rare, it did happen with this particular trade. And it's because there was news on this stock, and it's news that was anticipated, right? Folks were looking for app lovin to be added to the S&P 500. And while I didn't know that at the time I put the trade on, I became aware of it before the close, and even tried to get rid of, right, to get out of this trade before the close because of it. But the pricing was so out of whack because people wanted to hold these calls into the close. I would have had to pay more, so much to get out. I would have lost more than the max loss, which is ridiculous. So I didn't want to pay up to get out, but I didn't want to lose more than the max loss. So I had to stay around until after the close. Here's why, right? So the rules for option assignment and exercise, right? The person long an options contract always has the choice. That's why they're called options. If you own one, if you're long one, you have the option whether to exercise or not. Now, as a convenience, the rules state that you're going to be automatically exercised as long as your options position is in the money at the close by a penny or more. But as it's always your choice, as long as you do it early enough, you can tell your broker you don't want to be assigned. And I'll tell you when and why you might choose to do that in a minute, right? I'll also tell you in a minute why and when you would call them and tell them you do want to exercise your option, even if on the day of expiration, it closed out of the money. And it's situations like this one where AppLovin closed at 490, and I think it was 490 and 28 cents, 490 and just a few cents here on Friday, and so that would have been right. My long option would have been automatically exercised, but the 495 that I'm short, or that I was short 3 of them for each of these I was in, so 30 total, wouldn't have been. Now, if I had walked away and not hung out through expiration, I would have been sitting here with potentially 30 or 3,000 short short shares. Now, 10 of those or 1,000 of those would have been offset by the 10 long calls I had. So, but I still would have been short 2,000 shares. And if we look at what AppLovin did here today, right? It gapped up, and is currently trading at 547. That means, right, if I had been short those from 495, the strike of the short calls, that would have been more than $50 a share. I don't want to be short 2,000 shares of that, or 100 grand. That is way too much for something that where I shouldn't have lost more than the max loss, which would have been $3,700. That's almost 30 times the max loss that the platform would have showed me. But the reason those calls stayed bid into the end of the day on Friday is folks were anticipating that that AppLovin was going to be added to the S&P 500, and they wanted to be those they wanted to own those long calls, and they knew that their option, their choice, whether to exercise those calls or not, remained available to them for up to 90 minutes after the close. So when about 75 minutes after the close, the news came out that AppLovin was going to be added to the S&P 500, these smart call buyers, because they wouldn't have kept those things bid so late on the day of expiration if they didn't know that they could contact their broker afterwards and exercise and get those shares. So they did that, right? And being short those options, selling it to them, I would, or not would have, I did need to deliver to them those shares. So if I had walked away at the close thinking that I was safe those short options, I would have been wrong. And I already had learned by the close, as I mentioned before, that there was this risk because the news was expected that AppLovin might be added. So I needed to hang around until the news came out of which stocks were going to be added or weren't, because if they were going to be added, I was pretty certain those 495s were going to be assigned to me, that I'd have to deliver the shares. And so then I would have to exercise the 500 calls that I was long, right? The 20 of them that I was long, so that I could buy them at that price and not the price that they gapped up to almost immediately, just short of 530, right? So only by making sure I hung around and made sure all my calls were exercised did I limit myself to max loss. And if I had just walked away and not done this, it would have been much, much, much worse. Now, at the same time, if the news didn't come out, closing only just a few pennies above the 490 calls that I was long, these would have been automatically exercised. And I would have been at risk if the news didn't come out that AppLovin might have gapped down here today. And why do I want to go home over the weekend long AppLovin, long 1,000 shares of AppLovin at 490 if it could be trading at 480 or lower? I'd rather not take the risk of the overnight move and not buy them. Well, it's just as simple, right? For the options I'm long, I own the option. So I just need to call my broker and say, yeah, I know if I don't do anything, you'd automatically exercise me, but don't, right? And then I'm not gonna call away somebody else's shares. So on my platform, it's as easy as clicking the option, right-clicking the option, and choosing that whether I want to exercise or instruct my broker to lapse, to not exercise. That's on Interactive Brokers. I believe on Toss in here, which I used from time to time on some other accounts, right? In the monitor tab, you can right click on an option and exercise. I think you need to call the trade desk, if I remember right, on Thinkorswim to tell them not to exercise a particular contract, but it is still your choice and you always have that available to you. Now, the other way to protect yourself is to always exit equity options before the close on expiration day, unless it's your intent to have exposure to what happens after the close, or if you're intending to have things exercised or assigned, which sometimes we do, right? Sometimes we're short puts because we want to be put the stocks. Sometimes we're short calls because we want stuff called away. But if you think there's some risk of something happening, well, then just get out before the close. So at this point, you know how to protect yourself from some of these things that could go on, and hopefully I am saving you from some disastrous situations in the future. And keeping things always contained to max loss is a great way to survive, and I want you to survive. Be back here next Monday when we go through this again. And until then, as always, good trading.